Okay, let's unpack this. Imagine for a moment that you're managing your digital wealth, navigating the bustling, ever-evolving landscape of crypto assets. You want to move them, maybe trade them, or perhaps put them to work in some new decentralized application. But here's the kicker. Are you swapping them, bridging them, or are you simply converting them? And does understanding the difference even matter in 2025? Well, the short answer is yes, absolutely. And here's where it gets really fascinating. Welcome to a deep dive into the dynamic world of crypto asset movement in 2025. Today, we're cutting through the jargon, getting past all the noise to really explore the critical distinctions between swaps, bridges, and conversions. We've looked at, well, a whole stack of insights from industry titans like Cointelegraph and Symbiosis Finance, some cutting-edge analytics from Intellectia.ai, and even some, rigorous research from Aratiro, all to bring you the clearest, most actionable picture possible.
Right. Our mission today is, well, it's simple yet crucial to equip you with a crystal clear understanding of what's truly changing in this space, why these shifts are so significant, and most importantly, how they directly impact your interactions with the blockchain world. We want to provide you with a real shortcut to being well-informed, making sure you're not just aware, but actually ready for the accelerating evolution of decentralized finance. So we'll clarify the often confused terminology, analyze the major trends driving user behavior, highlight some groundbreaking innovations that are reshaping the landscape, and importantly, critically discuss the inherent risks, all designed to help you navigate this complex, exciting space with genuine confidence.
Okay, so let's start by peeling back the layers on these three fundamental terms: swaps, bridges, conversions. They might sound interchangeable to, the casual observer, but in the nuanced world of crypto asset movement, they represent fundamentally different operations, each with its own mechanics, its own advantages, and its own risks. We're talking about the very fabric of how you interact with your digital assets directly, peer-to-peer, and with, well, ever-increasing efficiency. All right, let's dive into crypto swaps first. Direct decentralized exchange. At its heart, a crypto swap is basically a direct wallet-to-wallet exchange of one cryptocurrency token for another. Think of it like a rapid single-step trade. You're not going through a traditional centralized exchange with order books and, complex matching engines. It's more like, well, like trading baseball cards with a friend, as we often say. But instead of physical cards, it's digital assets. And instead of a handshake, it's governed by these incredibly secure, self-executing smart contracts. You're simply exchanging one digital asset for another directly and often in mere seconds. And this directness, it brings with it a host of really compelling characteristics and advantages. First, and this is the big one, there's absolutely no fiat involvement. None. This isn't about cashing out your crypto into traditional money like USD or euros, or buying crypto with your bank account. It's purely crypto for crypto. You're taking your existing digital wealth and reallocating it within the crypto ecosystem, maybe optimizing your portfolio or grabbing a specific token needed for a new DeFi app.
Yeah.
Second, you'll notice the absence of traditional order books. Unlike those centralized exchanges where buyers and sellers place specific orders and wait for a match, swaps often leverage something called automated market makers, AMs.
Right, the AMMs.
These ingenious systems use liquidity pools, essentially large reserves of various tokens provided by users like you to facilitate trades instantly. This ensures deep liquidity, meaning there's almost always a counterparty for your trade. You don't have to wait for someone to match your specific price or amount. It's like a constant, always-on marketplace.
Exactly. And this point about AMMs and liquidity pools is, yeah, it's critical. But what's truly transformative, and perhaps the most crucial advantage of a swap, it's the aspect of zero custodial risk. When you perform a swap on a decentralized exchange, a DEX, you retain complete control of your private keys throughout the entire process.
That's huge.
It is. Your assets never leave your wallet to sit on some third-party platform that you don't control. This directly addresses those significant concerns around exchange solvency, security breaches, or even regulatory interventions that have, well, unfortunately plagued the crypto space over the years.
We've all seen the headlines.
Exactly. We've seen situations where centralized entities have faced collapses, freezing user funds, sometimes permanently. With a swap, you are your own bank. You maintain absolute sovereignty over your digital assets. This fundamentally aligns with the original ethos of cryptocurrency,
And building directly on that point, for many decentralized swaps, there's no know your customer verification required, no KYC. This means you don't need to submit personal documents, which offers a greater degree of financial privacy for the user. You're just connecting your wallet, confirming the transaction, and the smart contract handles the rest. Pretty seamless. Okay, to really bring this to life, let's imagine a scenario. Say you hold Bitcoin, maybe as a long-term investment, but you've discovered a fascinating new decentralized application, a DeFi protocol built on Ethereum, and you need Ethereum ETH to participate. Maybe you want to stake it or acquire a specific governance token for a DAO, a decentralized autonomous organization. Instead of sending your Bitcoin to a centralized exchange, selling it for fiat, then buying Ethereum with that fiat and then withdrawing the Ethereum, which is a multi-step, time-consuming, and potentially costly process.
Right, lots of steps, lots of fees potentially.
Exactly. A swap allows you to directly exchange your BTC for ETH in a single, streamlined transaction, often facilitated by a smart contract on a DEX like Uniswap or maybe PancakeSwap. Your Bitcoin leaves your wallet. Ethereum arrives almost instantly. It's quick, it's efficient, and it happens entirely on-chain, visible for all to see, but without revealing your personal identity.
Yeah, and understanding swaps isn't just about knowing a definition. It's fundamental because they represent a core principle of decentralized finance, true peer-to-peer asset exchange without intermediaries. This offers, as you said, enhanced privacy, security, and efficiency compared to traditional methods. Those methods might involve multiple steps, often opaque fees, and reliance on third parties you have to trust. It embodies the very spirit of decentralization that crypto was founded upon. It gives users more direct control, more autonomy, and frankly, a more robust and resilient financial experience. Plus, the transparency of smart contracts means you can, if you want to, audit the code. You can see exactly how the exchange works. That fosters a level of trust that traditional, often opaque financial institutions really struggle to match.
Okay, so that's swaps, exchanging different tokens, usually within the same blockchain ecosystem. Now let's talk about bridges. As the name suggests, these are about something else entirely. They're about moving the same token across different blockchains. It's like building a secure tunnel, maybe a metaphorical one, between two separate digital territories that don't inherently talk to each other. Imagine you have a specific digital asset, let's stick with Ethereum, but you want to use it on a blockchain that isn't Ethereum's native network, maybe Polygon, Solana, or Arbitrum. That's precisely where a bridge becomes, well, indispensable. But first, maybe we should clarify, why can't you just send a token from one blockchain to another directly? Why the need for a bridge at all?
That's a great question. Because blockchains are typically sovereign, isolated digital ledgers.
Right.
An Ethereum token, like ETH itself, or an ERC20 token, only exists and is verifiable on the Ethereum network. It doesn't understand the Solana network or the Binance Smart Chain. It's like trying to spend euros in Japan without exchanging them first.
Right, different operating systems, essentially.
Exactly. Each blockchain has its own rules, its own consensus mechanisms, its own way of verifying transactions. Direct native transfers between them are generally impossible, so precisely. That's where the bridge mechanism comes in. A crypto bridge works by effectively locking your original asset on its native blockchain, let's say your ETH on the Ethereum mainnet. Once that ETH is securely locked in a smart contract, an equivalent wrapped or represented version of that asset is then minted on the different target blockchain. Let's say WETH wrapped ETH on Polygon.
Okay, so it's like a placeholder.
Kind of, yeah. This wrapped token is essentially an IOU. It's a derivative token that's backed one-to-one by the original locked asset. It allows the value of your ETH to be transferred and utilized in an entirely new ecosystem, like Polygon's DeFi landscape, while maintaining the original asset's integrity, still locked safely on its native chain. And when you want to bring the asset back to Ethereum, you would burn the WETH on Polygon.
Destroy it.
Effectively, yes. Burning it signals the smart contract back on Ethereum to release your original ETH from the lockup. It's quite a sophisticated system for maintaining value parity across these disparate networks.
Now, you might be thinking, why go through all this effort? What's the compelling reason to bridge assets? The answer is, well, manifold. Primarily, it's to tap into new decentralized applications, those dApps, or unlock novel staking opportunities, or even just participate in entirely different blockchain communities that might not exist or aren't as robust on the asset's native chain. You're essentially expanding the utility and the reach of your digital assets, opening them up to a whole universe of possibilities beyond their original home.
And a major driver, a really practical one for this cross-chain movement, is often the pursuit of lower fees and faster transactions, let's be honest, right?
Definitely. Gas fees can be brutal sometimes.
Exactly. Moving an asset to a layer 2 solution like Arbitrum or Optimism, or to a different layer 1 blockchain altogether like Avalanche or Phantom, can significantly reduce those sometimes notoriously high transaction fees and increase processing speed compared to a heavily congested chain like the Ethereum mainnet often is. This is a massive draw for users looking for more economical and faster interactions, especially if you're doing frequent transactions or dealing with smaller amounts of capital. However, and this is crucial, it raises an important question that users absolutely must consider. What trade-offs are involved in gaining these efficiencies?
There's always a catch, isn't there?
Well, perhaps not a catch, but a consideration. While you gain speed and lower fees, you are introducing additional smart contract risk. You're relying on the bridge's security. And these bridges are complex pieces of software, making them potential targets for malicious actors, as we'll discuss later. It's a risk-reward calculation.
Okay, let's make this even more concrete. Let's say you hold Ethereum on the Ethereum mainnet, but you want to participate in a promising new yield farming protocol built on the Solana blockchain. High speed, low fees over there. You'd use a bridge, maybe something like the Wormhole bridge, to move your ETH from the Ethereum blockchain to the Solana blockchain. The bridge would lock your ETH on Ethereum and mint an equivalent wrapped ETH token on Solana. With that wrapped ETH now in your Solana wallet, you can interact with Solana's DeFi ecosystem, taking advantage of its lightning-fast transactions and often minuscule fees. When you're done, or if you simply want your original ETH back on Ethereum, you'd reverse the process. Burn the wrapped ETH on Solana, and your original ETH is unlocked and returned to your wallet on the Ethereum network.
It's like a digital customs process, really, enabling global trade within the Web3 world. Ultimately, bridges are absolutely essential for the interoperability of what is clearly becoming an increasingly multi-chain future. It's not just Ethereum anymore. As more blockchains emerge, each specializing in different functionalities, some better for gaming, some for NFTs, some for high-speed trading bridges, allow your assets to be fluid and useful across this entire Web3 landscape.
They break down the silos.
Exactly. They break down silos, expanding your opportunities immensely, allowing you to chase the best yields, the most innovative dApps, or simply the most efficient transaction costs, wherever they might be. They are the conduits, the tunnels that connect these disparate blockchain islands into a vast interconnected digital continent, creating a truly global, decentralized financial system. Without them, the multi-chain vision would remain fragmented and, frankly, far less powerful.
All right, so we've got swaps for exchanging different tokens and bridges for moving the same token between different chains. Now let's talk about conversions. This term gets thrown around quite broadly in crypto, doesn't it?
It does, yeah. It can be a bit ambiguous.
But in the specific context of crypto asset movement that we're discussing today, it typically refers to a couple of distinct scenarios. Most commonly, it means fiat conversions. So converting your cryptocurrency to traditional government-issued money like USD or EUR, or vice versa, buying crypto with fiat. But it can also apply to specific platform-centric tools offered by usually centralized exchanges. They might bundle several steps into a seemingly simple convert button, often hiding a more complex process underneath. Think of when you might convert Bitcoin to your local currency on a platform like Coinbase or Binance, or maybe even use a single convert feature within certain wallets that aren't fully decentralized.
And this is a really crucial distinction to make. It highlights the fundamental difference from the direct, often transparent nature of swaps and bridges we just talked about. Unlike the peer-to-peer on-chain mechanics of decentralized swaps, or that secure locking and minting process of bridges, conversions through traditional or centralized platforms can sometimes involve hidden delays, opaque fee structures, or multiple intermediary steps that are abstracted away from you, the user.
So it looks simple on the surface.
Exactly. While they present a simplified front in the user interface, often just a single button click, the underlying process can be less direct, less transparent, and it can reintroduce counterparty risk and custodial risk, the very things decentralized solutions aim to eliminate.
And this is where those hidden complexities really come into play, isn't it? While seemingly convenient because they look simple on the user interface, these conversion tools might mask the true costs involved. For instance, the price you see displayed might include a hidden spread, the difference between the buy and sell price that effectively acts as a fee.
The spread can be significant.
Or there might be hefty withdrawal fees to move your fiat back to your bank account later. Furthermore, there can be unexpected time delays for your assets to settle, especially with fiat withdrawals, which often have to route through the traditional banking system. Slow and clunky sometimes. This is the key difference from the near-instant and fully transparent nature of a decentralized swap, where you can often see the exact gas fees and potential slippage directly on the interface before you confirm the transaction. With conversions, you're often trading a potential lack of clarity and transparency for perceived ease of use. You're basically paying a premium, sometimes unknowingly, for that convenience and for the intermediary service.
Which raises an important question for any savvy user, really. Are you truly getting a seamless, cost-effective experience with these conversion tools? Or are there layers of complexity, cost, and potentially counterparty risk that a direct swap or a bridge would completely avoid? Being acutely aware of this distinction helps you make genuinely informed choices about where and how you move and manage your assets. It could potentially save you significant time, money, and maybe even some stress. It really encourages critical thinking, doesn't it? About whether the convenience offered by a centralized conversion tool truly outweighs the transparency, the self-custody, and the peer-to-peer benefits that decentralized alternatives offer. It's about understanding the full picture, not just the glossy surface presented to you.
Okay, so now that we've clearly decoded these foundational terms, swaps, bridges, conversions, let's pivot. Let's talk about what's actually happening on the ground in the market itself, because here's where the numbers start telling a truly compelling story. A story of a silent but seismic shift in how people are interacting with their crypto assets, a movement that's quickly accelerating and really redefining the structure of the industry. So let's look at decentralized exchanges versus centralized exchanges, DEXs versus CEXs. The data is pretty stark. It's almost revolutionary, you could say. In a significant market shift observed in Q2 2025, decentralized exchange, DEX spot trading volume surged. It jumped by an impressive 25.3%, reaching approximately $876 billion. Now compare that to what was happening simultaneously on the other side. Centralized exchange, CES trading volume actually slid nearly 28%, dropping to $3.9 trillion. Now, okay, CEXs still command a larger absolute volume for now. But the trend is undeniable and dramatic. This isn't just a ripple. It feels like a profound current pulling users towards decentralized platforms.
Yeah, this data, which has been meticulously highlighted by sources like Manafin, Symbiosis Finance, and Cointelegraph, it signals a clear and accelerating trend. Users are increasingly gravitating towards decentralized platforms. What's truly fascinating here isn't just the sheer volume, but the speed and the scale of this migration. It suggests a fundamental change, not just in where users trade, but in their core behavior and, crucially, their trust models.
Trust is key.
Absolutely. It's not just a minor fluctuation in market share, it's a significant realignment of market activity. And it seems driven by a deeper understanding of the inherent risks and benefits of each model. Users are actively seeking alternatives to traditional centralized models, especially perhaps in the wake of significant events that have shaken trust in centralized custodians over the past few years.
What this tells us, loud and clear, is that users are actively choosing these direct, on-chain swaps over the more traditional, often multi-step fiat trading cycles that are typically associated with CEX platforms. They're voting with their wallets for true decentralization, for transparency, and for direct control over their assets. It's a powerful statement about where the market's priorities seem to lie now, moving away from that old adage, not your keys, not your crypto, towards embracing your keys, your control.
And I agree, this doesn't feel like merely a fleeting trend. It seems to reflect a broader maturation of the crypto market itself. The explosive growth of DEXs implies increased liquidity and functionality within decentralized ecosystems, which is directly challenging the long-standing dominance of centralized intermediaries. If we connect this to the bigger picture, it's really about the continued fulfillment of the original ethos of crypto, empowerment through decentralization.
Going back to the roots.
In a way, yes. It suggests that the market is becoming more resilient, more robust, and less susceptible to single points of failure by distributing power and control more widely across its participants. It's a move towards an architecture that is inherently more secure and censorship-resistant qualities that are increasingly valued by the savvy crypto user. This trend could fundamentally reshape financial infrastructure far beyond just crypto trading in the long run.
So let's dig deeper into why. Why are people making this dramatic shift towards swaps and decentralized exchanges? What's compelling them to move away from platforms they might have used for years? There are several incredibly compelling reasons, starting, for many people, with the practical matter of cost.
Yeah, one of the biggest drivers seems to be consistently lower fees.
When you perform a swap on a DEX, you typically only incur the network transaction fees, the gas fees, or perhaps smart contract execution fees. These are the direct costs of processing your transaction on the blockchain itself. What you generally avoid are the hidden markups, those bid-ask spreads we mentioned, or the percentage-based transaction fees that are typical of many centralized exchanges. They're essentially charging you for their intermediary service. With the DEX, you're not paying a premium for a middleman, you're paying for the direct computation on the decentralized network.
And that transparency in the fee structure is a truly significant draw for users. It really is. They know exactly what they're paying for before the transaction executes. You see it right there. This helps avoid those unexpected costs that can quickly erode profits, especially if you're doing frequent trades or dealing with smaller amounts of capital.
Makes budgeting easier.
Absolutely. This directness fosters trust and allows for far more precise financial planning within the DeFi space. That's critical for both retail users and, increasingly, the institutional players who are now entering this market. It eliminates that feeling of hidden charges that often plagues traditional financial services.
Okay, another key advantage fueling this shift is deep liquidity and smoother execution. Thanks to those automated market maker, AMM-enabled liquidity pools we discussed earlier, swaps benefit from extensive, constant liquidity, always available. This means there's significantly less risk of slippage. Remember, that's when your trade executes at a different price than you intended. That often happens with large orders on thin order books on CEXs. With AMMs, the price you see when you initiate your swap is much closer, often identical to the price you actually get. More predictability.
Indeed, the EMM model is quite revolutionary because it provides constant liquidity. It ensures that even large trades can usually be executed with minimal price impact. This is a major improvement over thin order books on some centralized exchanges that can lead to significant slippage and unfavorable pricing, particularly during volatile market periods when liquidity might suddenly just dry up.
Yeah, you see those huge spreads sometimes.
Exactly. This contributes to a more predictable, reliable, and efficient trading experience. That's crucial for both retail and institutional users who value certainty in their transaction execution. The mathematical formulas underpinning AMMs ensure a price is always available, even if it adjusts dynamically based on the trade size relative to the liquidity in the pool.
And as we touched on earlier, true self-custody and privacy remain paramount for so many people in the crypto community. It's almost a core value. With swaps, because they're decentralized, you retain control of your private keys throughout the entire process. Your assets never leave your wallet. You don't need to entrust them to a third party. And for many DEX platforms, there's no need for that KYC verification, which further enhances user privacy.
Right. And this directly addresses that critical issue of trust and security that has, sadly, been a recurring theme in the crypto space. Users are not entrusting their assets to a third party. This mitigates risks associated with hacks, insolvency, or even regulatory seizures that can affect centralized entities. We've seen it happen. The absence of KYC also strongly appeals to those prioritizing financial privacy and freedom. Though it's important to acknowledge the evolving regulatory landscapes globally. There are ongoing discussions around digital identity and finance that might impact this over time.
It's a moving target.
It is. It's a delicate and continuous balance between individual sovereignty and broader regulatory expectations.
And finally, there's the speed factor. Faster transactions. Swaps work with remarkable speed, generally. There's no multi-step order execution process, no waiting for matching orders, no lengthy settlement periods like you might see in traditional finance, or even some CEX withdrawals. Once the smart contract executes, often within seconds, depending on the blockchain's speed and congestion, the tokens are exchanged. The transaction is recorded on the blockchain. Done.
Yeah, speed is absolutely paramount in these fast-moving crypto markets. Things change in minutes, sometimes seconds. Instant transactions mean users can react quickly to market changes, capture fleeting opportunities, and avoid delays that might impact their strategies or cause them to miss out on profit. This efficiency is a core advantage that traditional exchanges often struggle to match for certain types of operations, which inherently involve more intermediaries and processing layers, each adding latency. So this powerful combination of benefits, lower fees, deep liquidity, self-custody, privacy, and speed, it's clearly articulated across leading sources like BlockTech Solutions, Cointelegraph, TradingView. It unequivocally underscores the undeniable shift in user preference we're witnessing. It's a really compelling argument for decentralization in action.
Okay, so as users are increasingly flocking to these decentralized solutions, the technology underpinning them isn't just sitting still. It's evolving at a breathtaking pace. We're seeing incredible innovations that are making crypto asset movement not just faster and cheaper, but also more powerful, more seamless, and crucially, far more secure. It's a truly exciting time to be watching this space develop. One of the most significant advancements we're observing is how the distinct lines between bridging and swapping are beginning to beautifully blur. They're converging. For a long time, if you wanted to swap tokens, you'd go to a DEX. If you wanted to move tokens between chains, you'd go to a separate bridge platform.
Right, two different tools, two different websites usually.
Exactly. Often separate, siloed platforms requiring multiple steps, different interfaces, and just a higher cognitive load for the user. You had to know what you were doing. But now modern tools are emerging that integrate both functionalities into a single, seamless user experience, making the multi-chain world far more accessible for everyone.
Symbiosis Finance is a prime example of this transformative innovation. We mentioned them earlier. It allows users to perform complex cross-chain swaps and bridges within one intuitive interface. It intelligently aggregates liquidity across dozens of different chains behind the scenes. What's truly fascinating here is how these platforms are taking incredibly complex, multi-step underlying processes involving smart contracts on different networks, wrapped tokens, liquidity routing logic, and simplifying them into what feels like a single click for the end user.
Abstracting the complexity away.
Precisely. They're abstracting away the technical intricacies, making multi-chain interactions feel as easy and fluid as single-chain ones used to be. This kind of aggregation significantly reduces friction, minimizes potential user errors, and vastly improves the overall user journey in DeFi.
So this means you no longer have to, say, navigate separate platforms, understand intricate technical details like which bridge supports which token, or worry about manually converting your assets before bridging them. You can, for instance, directly swap an ERC20 token, that's the common standard on Ethereum, for a Solana-based token, all in one smooth operation through one interface. Or perhaps you want to swap a stablecoin sitting on Binance Smart Chain for some obscure altcoin that only exists on Arbitrum. You can potentially do that without ever needing to touch a centralized exchange or even thinking about what a wrapped token is. It's a significant leap in user convenience, opening up the entire multi-chain landscape without those previous technical barriers. It truly feels like the digital borders are dissolving.
Yeah, sources like Cointelegraph, Symbiosis Finance itself, and across protocol all emphatically highlight this crucial trend towards seamless, integrated cross-chain liquidity. It's a big deal for usability.
All right, let's shift gears slightly and talk about protocol-level enhancements, specifically Uniswap, a true behemoth, a pioneer in the DEX space. They are continuously at the forefront of this evolution, and with their upcoming V4 iteration, they're introducing a key innovation they call swap hooks. Now, this isn't just a minor update. These hooks are essentially customizable code segments that can execute at various points within a swap's lifecycle. This gives developers, and by extension users, really unprecedented flexibility and control over their transactions.
These hooks are potentially a game changer because they allow for a new level of programmability and efficiency directly at the protocol level without relying on external, often centralized off-chain services. Imagine the possibilities this unlocks. They can enable features like dynamic fees, where transaction costs adjust automatically based on real-time network congestion or maybe specific asset volatility.
More intelligent pricing.
They could facilitate on-chain limit orders, allowing users to set specific price points for their swaps without relying on external services that might hold their funds or introduce counterparty risk. Even more sophisticated custom liquidity management strategies can be implemented directly within the swap protocol itself, allowing liquidity providers, the LPs, to earn more efficiently or perhaps hedge against impermanent loss more effectively. This raises an incredibly important question, doesn't it? How will this newfound flexibility foster entirely new types of DeFi products and services that we haven't even begun to imagine yet?
Yeah, the combinatorial possibilities seem huge.
They really do. The potential for innovation here, for building entirely new financial primitives directly into the swap mechanism, is truly immense. We could see personalized trading experiences, novel risk management tools, or even entirely new asset classes emerge as a direct result of this hook architecture. So yeah, this innovation will profoundly enhance protocol capabilities. It'll make swaps more intelligent, more adaptable, more reactive. This could lead to lower overall costs for users, more sophisticated and automated trading strategies, and ultimately a much richer and more responsive DeFi ecosystem. It's about embedding advanced logic directly into the core trading engine, which is a significant departure from previous, more rigid protocol designs. Sources like ccn.com, Intellectia, and TradingView all point to this significant evolution in DEX functionality as a major leap forward for decentralized trading.
Okay, now let's talk about security advancements, specifically something called grief-free atomic swaps. Because here's a challenge within the decentralized world that many users might not even be aware exists. Grief attacks. These are malicious actions where a bad actor intentionally causes a transaction, like a cross-chain swap, to fail. Crucially, they're not trying to steal your funds directly in this scenario. Instead, their goal is simply to waste the other party's time, resources, maybe their gas fees, cause frustration, and undermine trust in the system.
It's incredibly annoying.
Right. Imagine initiating a cross-chain trade, paying the initial transaction fee, only for the malicious counterparty to just pull out at the last second, leaving you out of pocket for the gas and with absolutely nothing to show for it. It's a frustrating form of digital harassment that can significantly deter users from complex decentralized interactions.
And this is precisely what innovations like the 4-swap protocol are addressing with their concept of grief-free atomic swaps. These offer truly secure cross-chain exchanges designed specifically to prevent such attacks, ensuring that if one party fails to uphold their end of the bargain, the other party doesn't lose out. What's fascinating here is the continuous, proactive drive towards making decentralized interactions not just functional, but truly robust and resilient against these novel forms of attack that inevitably arise as the technology matures. It shows a real commitment to building a more reliable and user-friendly ecosystem. Now, the mechanism often involves sophisticated cryptographic techniques and specific smart contract designs, like hash time-locked contracts or HTLCs, which have been around but are being refined. In simple terms, these protocols ensure that both parties either complete their respective parts of the swap within a specified time frame, or the assets are automatically returned to their original owners, safely.
So there's a time limit.
Effectively, yes. If one party fails to complete their end of the swap, maybe they don't reveal a secret number needed to unlock the funds, the other party can recover their own funds without loss or undue delay, because the assets remain provably locked until all conditions are met or the time expires. This guarantees fairness and basically eliminates the incentive for griefing. Why bother if you can't cause loss?
Okay, so this directly translates to greater peace of mind for you, the user, when performing these complex cross-chain transactions. You're no longer vulnerable to intentional disruptions or these frustrating attempts to waste your time and money. It's about building foundational security and trust into the very design of these advanced operations, making them as reliable as possible. So let me ask you, our listener, this. With grief-free atomic swaps specifically designed to prevent these frustrating and costly attacks, would such a guarantee convince you to go fully on-chain for all your cross-chain transactions? Would you feel comfortable ditching intermediaries altogether?
It's a compelling proposition. Research from ArcSef, particularly that paper 4-swap, grief-free, bribery-safe atomic swaps, alongside publications like Intellectia and CoinLive, all highlight this critical security advancement as a significant step forward.
Beyond specific protocols, the entire landscape of DEX platforms is experiencing rapid evolution on multiple fronts. Many decentralized exchanges are becoming increasingly optimized for Layer 2 solutions. We've mentioned Arbitrum, Optimism, and others. These incredible off-chain scaling solutions are built on top of main blockchains like Ethereum. What this means for you, the user, are even faster and significantly cheaper swaps than ever before. This further enhances the user experience and makes even microtransactions economically viable on DEXs.
And looking ahead, we can also anticipate the emergence of increasingly regulation-cognizant tools. This is interesting. This includes decentralized platforms potentially integrating features for KYC, know your customer, and AML, anti-money laundering, designed perhaps optionally to meet the growing demands of global financial oversight.
A concession to the real world.
Perhaps. It's a critical development for bridging the gap between decentralized finance and traditional financial institutions. It acknowledges the inevitable convergence while, ideally, trying to retain the core benefits of decentralization for those who still value permissionlessness. It's a pragmatic step towards broader institutional adoption, arguably.
And what's the ultimate goal here with all these platform evolutions? To create more intuitive, more polished, more user-friendly interfaces. The aim isn't just to onboard new individual users who might be intimidated by the current complexity of DeFi. Let's face it, it can be daunting. But crucially, it's also about attracting and seamlessly integrating institutional players, banks, hedge funds, asset managers, into the decentralized finance space. Imagine a future where a traditional bank or a large asset manager can offer DeFi products to their clients, seamlessly interacting with these decentralized protocols through compliant, easy-to-use interfaces.
This suggests a future where DeFi potentially maintains its core decentralized principles like transparency and open access, while simultaneously becoming more accessible, more user-friendly, and maybe more compliant with global financial regulations where needed. This paves the way for truly broad adoption by both institutions and mainstream users alike, moving crypto beyond a niche interest and into the everyday financial toolkit. However, this does raise that important question, the one the community is constantly grappling with. How will we effectively balance the core tenets of decentralization things like permissionlessness and censorship resistance, with the increasing demands of regulatory
The
compliance.
billion-dollar question.
It really is. It's a tightrope walk that will undoubtedly define the next critical phase of Web3's evolution. And sources like ccn.com, Intellectia, MEAFN, Alchemy, XT, Co-Intelegraph, they all point to the significant platform evolution and proactive regulatory consideration as key drivers for the future.
Now, while the pace of innovation in this space is truly electrifying, it's absolutely crucial for us to acknowledge that the journey towards a fully decentralized and seamlessly interoperable future isn't without its significant bumps, its challenges, and indeed its risks. We've collectively learned some incredibly hard and, frankly, very expensive lessons along the way, particularly when it comes to the relatively newer technology of cross-chain bridges. It's a powerful reminder that cutting-edge technology often comes with unforeseen vulnerabilities. Let's talk about the shadow of bridge hacks. While bridges offer this incredible utility, allowing assets to flow across different blockchains, they have also, unfortunately, become prime targets for highly sophisticated malicious actors, hackers. We've seen stark and alarming reminders of these dangers. Significant thefts and security breaches have jeopardized user trust in cross-chain solutions time and again. These weren't minor incidents either. We're talking about hacks that have resulted in hundreds of millions, sometimes even billions of dollars in losses across various bridge protocols.
Yeah, the numbers are staggering.
Think of incidents like the Ronin bridge hack, which saw over $600 million stolen, or the wormhole bridge exploit, where hundreds of millions of dollars were drained. These events sent shockwaves through the entire industry.
Right. And these bridge hacks, while undeniably unfortunate and damaging, they starkly underscore the nascent and still maturing nature of some of this cross-chain technology. Each incident erodes user confidence and highlights the critical, urgent need for robust, multi-layered security. It's a constant cat-and-mouse game between the brilliant builders creating these systems and the equally sophisticated attackers trying to break them.
An arms race.
It really is. If we connect this to the bigger picture, it serves as a powerful reminder that innovation, especially at this frontier, often comes hand in hand with new vectors for attack. Continuous vigilance, along with rigorous, ongoing security testing and audits, is just paramount in this rapidly evolving space. It's the unavoidable price, perhaps, of being on the cutting edge. And every attack, while painful, becomes a learning opportunity for the ecosystem to fortify itself further.
Absolutely. These high-profile incidents serve as a powerful and, as you said, expensive reminder of precisely why platforms and protocols in this space must prioritize audits and security. This isn't just a suggestion anymore. It's an existential necessity for their survival, for gaining user adoption, and for maintaining the broader integrity of the entire ecosystem. Projects that try to skimp on security audits or that have opaque security practices, they simply won't gain the trust needed to thrive in this environment where user funds are directly at stake.
So, for you, the listener, this means exercising an even higher degree of critical thinking and due diligence. You have to be careful. When considering using a bridge or any new DeFi protocol, it's absolutely essential to do your homework. Research its security history thoroughly. Actively look for independent audit reports from reputable security firms and check when they were done and what they found. Investigate the experience, the track record, and the transparency of the development team behind it. Are they known? Are they anonymous? This raises that important question again. What specific criteria should users employ to truly assess the security posture of a bridging solution or a DEX, given the inherent complexities?
What should they look for?
Well, beyond just audit reports, you should look for active bug bounty programs. Do they incentivize finding flaws? Verify if the code is open source for community review. Understand the governance model. Is it truly decentralized, or does it rely on a small, potentially vulnerable multi-sig wallet controlled by a few people? We could look at a hypothetical security incident timeline, as suggested by some sources, to vividly illustrate how such events have pushed developers to build more resilient systems and learn from past mistakes. It shows how security practices improve across the board over time. This kind of proactive scrutiny is really your best defense in this space.
But there's always a silver lining, right? Even in the shadow of these major hacks, every exploit, every vulnerability discovered ultimately drives the industry to innovate and strengthen its defenses. These challenges, as painful as they are in the moment, directly lead to the development of more secure protocols and more robust systems in the long run. It's a continuous, albeit sometimes brutal, cycle of challenge, learning, and improvement that ultimately makes the entire ecosystem more resilient.
Absolutely. The ongoing evolution of secure technologies, like those grief-free atomic swaps we discussed earlier, directly stems from these past challenges and the hard lessons learned from bridge exploits and other hacks. These advancements are a testament to the resilience and the often collaborative nature of the Web3 community, where problems are openly discussed and solutions are collectively pursued. The focus is always, ultimately, on making the entire space safer, more reliable, and more user-friendly for everyone. It's a difficult but necessary journey towards building a truly robust and trustworthy decentralized future.
So what does all of this mean for you as we navigate the rapidly evolving landscape of crypto in 2025? Let's try and wrap this up. We've journeyed through the critical distinctions of swaps, bridges, and traditional conversions. We've witnessed a truly seismic shift towards decentralized exchanges, driven by the undeniable allure of lower fees, true self-custody, and unparalleled transaction speed. We've also explored the cutting edge of innovation, from unified solutions that blur the lines between bridging and swapping, to Uniswap v4's customizable hooks, and the groundbreaking promise of grief-free atomic swaps, all while internalizing the crucial, sometimes painful, lessons learned from past bridge security incidents.
Ultimately, understanding these powerful tools and the underlying market trends empowers you immensely. It helps you make truly informed strategic decisions in this fast-paced world of crypto. Whether you're moving assets for staking, actively trading, or exploring new and exciting decentralized ecosystems, knowing the why and the how behind each available option is absolutely key. Key to seizing opportunities, effectively mitigating inherent risks, and ultimately taking full control of your digital financial journey. It allows you to participate in the decentralized future with greater confidence and, crucially, greater autonomy.
With DEXs volume soaring and innovation accelerating like this, the question isn't just if these technologies will evolve, but how fast and, critically, how securely. The challenge for all of us, builders and users alike, will be to relentlessly balance groundbreaking innovation with robust, battle-tested security, ensuring we build a truly decentralized, user-friendly, and resilient financial future for everyone. And hey, if this deep dive helped clarify the evolution of swaps, bridges, and cross-chain tools in 2025 for you, and you found this conversation valuable,
please take just a moment to hit that subscribe button if you haven't already, leaving a comment with your thoughts below, or maybe sharing this deep dive with a friend who's also navigating the crypto space. It really helps support the channel. It boosts our visibility in the algorithm, and it allows us to keep creating quality content like this for you. Thank you for joining us on this deep dive. We'll catch you next time.